Well, good evening and welcome to this live stream on the 11th of March 2025. I'm Martin North from Digital Finance Analytics, and great to have you on the live stream tonight. Thanks for taking some time out of your Tuesday evening. Always appreciated. Very important conversation tonight, I think, not least because of what's happening with the markets, but also what's happening with household finances. And we're going to focus a little bit on both of those topics tonight because they're sort of connected, of course. Before I do that, let me just remind you that we're not providing specific financial or legal advice on the channel. This is a general conversation only. We do moderate the stream, but feel free to throw your comments and questions and observations in. Just watch what you say and how you say it, please. Respect everybody else in the chat. If you would like to ask me a specific question, though, if you use Walk the World, that'll get it into my queue and to make sure I sit. I can't follow everything that's going on in the chat simply because there's just so much happening. I have enabled Super Chat, which means that if you want to get your question top of the list, you can do that using Super Chat, or indeed make a contribution to what we do around here. It's always greatly appreciated. We don't do this for profit. We do this because we think there's a really important conversation to be had, especially in the current conditions that we find ourselves in. So we're going to cover a few important topics tonight, but I thought just a quick little check-in. This is actually the ASX 200, and you can see there that it's come significantly back from 8.6 to 7.8. Of course, other markets are also pretty wobbly too. And that, of course, is driven by a whole bunch of issues that we'll perhaps touch on in more detail shortly. It is no surprise, and I don't think we've seen the end of it. The NASDAQ is in correction territory. The Dow is also down, and the S&P 500, and of course the DXY is also down as well. That's the US dollar, and also the VIX as well. The VIX is around 27, 25 at the moment. That's the volatility index in the US, which of course is a very significant bellwether, and it was knocking around the 15 or below for quite some time, but it's quite a lot higher now, signaling, I think, probably more concerns ahead. And a quick check-in at the 2-year US shows that the bond yields are down quite a lot from where they were, which also tells us something quite important. And as we just quickly circuit the story here, gold is still hanging in there. Did drop back. It's up quite strongly. Perhaps no surprise. You're looking for somewhere to hide at the moment. Bitcoin, not so much. It's knocking around the 81 level. So all of these things are not really surprising, given what we've seen recently. And of course, that really has to be sheeted back to Trump and what Trump has been saying. Of course, the other day he did say that the chances are we might see a recession coming, and that really has been the trigger. That we're probably going to see more volatility ahead. And I found this chart quite interesting. This is comparing the S&P 500 change last time around, Trump 1, and now Trump 2. And you can see that, it's sliding away quite a lot more. Now, you can have different perspectives. There's somebody here that says, this is the dip everyone's panicking over. We've sort of got a lot further to fall before the bubble is unwound. That's probably true. At the end of the day, of course, it's difficult to read exactly how this is going to play out. Different people have different stories. At the end of the day, it depends on who you believe, I suppose, or who you don't believe. This particular one was quite interesting. February the 20th, JP Morgan CEO sold $234 million worth of stock. Warren Buffett announced a record billion cash, $344 billion cash on balance, and then now the NASDAQ's crashed, and this was last night. Others are pointing to the different indices that are all really beginning to go negative, and the capital rotation index or evidence is actually something which I keep an eye on. I don't believe it 100%, but it is quite interesting. And then, of course, you had this picture quite recently about the revised economic outlook, and we are expecting the Treasury account, US Treasury account, is down. It tends to drop, then rise again. And of course, we also had the the story about the strategic Bitcoin reserve, which wasn't quite such a big story as perhaps people expected, because they're just going to take the Bitcoin they've already got and just manage it slightly more effectively rather than buy new Bitcoin. So all of those things are by way of context. And the reason I've spent just a little bit of time on this is because, of course, a lot of Australian wealth is tied up directly or indirectly with what's happening in the US. A lot of our superannuation funds are invested in the US. And until quite recently, of course, the tech sector were the darlings. You have to say, I think now that maybe that's over for now. And that would suggest that there's got to be some different strategies bubbling around. The bottom line is, I think that there's a lot of uncertainty that we've not seen. We'll have to wait and see, I guess. Now, as we come in to look at Australia, on the way in, I just wanted to mention that Media Watch covered the housing con, or Labour's housing con, as Senator Andrew Bragg pointed out. Basically, the story here was, of course, that they announced 300 and something homes being bought under the Future Fund, but in fact they weren't bought. They were actually they were existing properties, not new properties built. So bought rather than built, which basically means it doesn't increase the stock. Another example, I think, of what we're going to see a lot of, in fact, on Media Watch, the guy there said, well, you got to understand how this works, that politicians see the story to try and get the best spin on it, and they were a bit found out on this one. We're going to see more of that, I think. But more generally, as I highlighted in my recent show, living standards are no better than a decade ago. And whilst we had real GDP up very slightly, this is GDP per capita up 0.1, you can see that we've still got a long way to go. And it's a decline of 1.65 over the period. Household spending continues to be very low. And you can see there that the goods and services are going in slightly different directions now, as I covered the other day. We've also got discretionary and essentials, so more spending on the essentials than discretionary. And of course, as I discussed also in my previous show, the fact is that a lot of the momentum in the economy is being driven by, guess what, public sector jobs, directly or indirectly. And that's a little bit of a problem insofar that momentum may not be feasible to continue. Now, turning on to housing, and in a segue into this sort of more deep discussion about household finances, there was a report from the Real Estate Institute that made the point that housing affordability is at its lowest point since they began monitoring, and the average repayment consuming 50.1% of median family income. Now, that's a very important metric, and you'll see me talking about this disposable income, what proportion's going on housing. The other factor to bear in mind, of course, is we've got a lot of people with looking on the mixture of jobs between the market and the non-market, as I said, but also, very interestingly, multiple jobs are up. So more people are working multiple jobs across quite a few industries. Healthcare is top of the list, then public administration, education. This is partly because people are having to try and find more hours, and working more jobs is one way to get a sense of what's going on. But that's not a good story. I see that in my surveys, by the way, as well. A lot of households saying, well, we can't get more income from our current work, so we're trying to work more jobs. That, of course, has some significant consequences in terms of household pressure, just in terms of surviving. And just to sort of round out the story, of course, now they're talking about 40-year mortgages. It may be the only way for first-time buyers to get into the market. But as the Finder analysis said, well, the problem there is that you're just paying a lot more interest. So the repayments might be slightly cheaper, but you're still paying a lot more. And that's really a part of the problem. So we've got ourselves to the situation now where, to get into the housing sector, more and more people are having to spend more and more of their money just to get in. And that's really the problem that we're getting involved in. And what I find most interesting, but also most concerning, is this recent report that said that the parties are backed on the cash splurge. So basically, households are still looking for more government help and support to find a way through. The handout mentality, which of course encourages more government spending. And both sides of politics are playing this game and will play this game. And the question is that going to take us anywhere good? I would remind you that, of course, the extra liquidity gets pumped in the system, tends to go into the housing sector. That lifts housing prices, which makes housing more expensive. So it's a nil net sum game. And of course, the rental sector also follows as well. So I'm afraid that it's not necessarily a very good story. And that explains, of course, why we have the story of failing home ownership rates. This is the Hilda data. It's out-of-date data, but it's quite useful to understand what's going on. And the final point, when you look at the data here with Hilda, is that almost everywhere across the country, what you've actually got is the home ownership rates lower now than they used to be. And there's no real way back from that at the moment, given what we see. And the final piece of introductory data is that the auction clearance rates weren't flash. It's interesting that, there's still a lot going on, but not necessarily as much as we might think. And I guess I would also just make one other point as we think about households and their finances. We should think about those people caught up in the floods and the cyclone or ex-cyclone Alfred. And there was an article that said that we've already got 10,000 Australians have already lodged claims on their insurance. What I worry about are the people who actually aren't insured. And in my surveys, I'm seeing quite a few people who cut back their insurance. If they've got no mortgage, of course, they can avoid that. If they've got a mortgage, they have to insure the building, but not necessarily contents. So that's going to put a lot of pressure. I'll be interested to see how the insurance players respond to this. Last time around, they were very slow at paying out and found all sorts of reasons why not to pay out. So I'll be watching that. So the overall context is financial uncertainty. The overall context is household financial pressure. So then we can now move on and just talk briefly about my analysis, of course, as normal. And for those who may not have caught up, this is the way we do it. So we survey households on a rolling basis, put it into our core market model, and we then can overlay our segmentation to understand what's going on, slice and dice the data. And we can then also have a view as to where things may be going from a scenario perspective. And we'll touch on some scenarios shortly. And if we take all that data, the stress data, the price trajectory data, the buying and selling intentions, the migration data, the economic data, put it into the core market model, run the scenarios, and then we can form a view as to what's happening down at the postcode level. And I'm going to spend quite a lot of time today focusing in on the postcodes because the story is not the same across every postcode, lots of differences. And I've already had quite a few requests coming in for specific postcodes, so we'll cover some of that too. Now, just before I go on, let me just remind you that we do provide a one-to-one service. This isn't financial advice, but if you want to chat about a particular suburb and get into a lot more detail, if you're looking perhaps at thinking of selling or buying or whatever, we can do that using our desktop research. I can't give financial advice, but I can look at my data and look at the postcode and work out what's going on with trends. I can look at the stress, the home price trend data, the modeling and all those things. And you can have a conversation with me up to an hour via Zoom or phone. There is a cost involved because it actually costs a lot of time and effort to put all the information together. And if you're interested, you can contact me by my blog. The links are below. Booking about 3 to 5 weeks out at the moment. Got quite a few people who are actually quite interested in trying to figure out in the current environment what to do. A lot of first-time buyers trying to get into the market, trying to work out whether they should wait or whether they should not wait. A lot of people looking to downtrade. And I've had a couple of interesting conversations with people thinking about, for example, buying property next door to where they live to see whether they could actually put the two plots together and actually create a subdivision or create, an apartment block. And is that worth thinking about now? So lots of different conversations, and always happy to have those one-to-one conversations if you're interested. Now let's talk about the stress analysis that we do. And, you'll be familiar probably with this, but just for those who may not, we define stress very carefully. We don't use 30% of income. There's always confusion whether it's tax or net of tax, of course, or indeed underwriting metrics, but we look at cash flow, money in, money out. And so if households have more outgoings, excluding one-off discretionary, we define them as stress. If they're the mortgage, they're in mortgage stress. If they're renting, they're in rental stress. So this is a cash flow measure. Investors potentially have cash flow pressures too, and we can identify them as stressed investors, and we can aggregate it up to the financial stress level for the households in that particular postcode and report it both as a percentage and count. I tend to focus in on the counts because I think the law of big number is quite important, but the percentage does tell us some things too, and we'll do a little bit of both today. Just another quick point. This is the RBA chart. You may have seen it before, and they talk about the spectrum of household financial stress. It's quite useful because, of course, you move all the way across from budget pressures very much on the mild side through to missing payments and then ultimately to insolvency. And I'm measuring it here at the mild end. Now, the journey between budget pressures and perhaps missing payments and insolvency can be several years. And of course, along the way, people might decide to sell and get out. The banks are putting a lot of pressure on households at the moment to try and get them to sell and get out and pay back the bank before things go particularly bad. And of course, house prices have been quite strong. But nevertheless, if people are actually in budget pressures at the mild end and don't do anything different, change behavior or otherwise modify what their financial position looks like, then the budget pressures build up over time. They sometimes miss payments, they sometimes refinance. They might talk to a mortgage broker who suggests a refinance. They talk to the bank who might suggest a longer loan or a repayment holiday. ASIC made the point, though, that repayment holidays don't necessarily help. They just kick out the problem unless you change your behavior. So there is actually a very important point here that there is no surprise to me that we're not seeing high levels of delinquency and default. It's going up slightly, but not dramatically yet. But it's early days. And if we are going to continue to see these pressures on households and interest rates not coming down very much from where they are, and inflation more sticky than people expected, then these things are going to work through. And the bottom line, of course, is that households are still very much up against it. If you've got a mortgage, as we'll see, roughly half have a problem. If you have a rent situation, then more than 3/4 have a problem. So not everybody's caught, but quite a few are. Now, if I then move on and just talk briefly about the stress data to February, and for those who may not have seen the earlier show, I'll just recap on the fact that we've got rental stress up at 76% of people in the rental sector. You can see that it's hanging there at that level. It's been hanging there for some time. I will say that some of the government support mechanisms, like the electricity support and some of the travel facilities up in Queensland, for example, have helped a little bit. Electricity support being perhaps a big one, although that may not go on. We'll see what the budget says. But the fact is that rents are still rising. And mortgages, roughly half of those in the mortgage sector, have a financial cash flow pressure around their mortgage. Doesn't mean they're going to default tomorrow, but what it means is they're having to make really hard decisions about where they spend their money and what they spend the money on. And in some cases, from my analysis, I do believe that some households are making perhaps poor decisions rather than good decisions about where they're spending that money and what they think is really important. A good example, of course, is the big mobile phone bill or the big subscription service to YouTube plus 4 or 5 others, seen as now essential. Well, I suppose that's a matter of perspective. And just quickly, the RBA, of course, reports the debt-to-income ratio at 183 at the moment. Now, the problem with that is that it doesn't really tell you the full story because it includes all households, whether they have a mortgage or not, and includes small businesses. The true metric is probably between 6 and 7% on average times. So the debt-to-income ratio is quite high, and that's a problem. Here is the data for February, and you can see there in yellow the areas where there's been a rise in stress. So it's been quite significant in New South Wales, in South Australia, in Western Australia, and overall the financial stress metric went up slightly. More than 1.859 million mortgage stressed households out of the 9.9 or 10 million households in the country. Rental stress grew in the ACT, New South Wales, Queensland, South Australia, Western Australia, 76.9%, which is 2.3 million households in rental stress. Stressed investors went up slightly, particularly in ACT, New South Wales, the Northern Territory, Queensland, and Victoria. And there are around 500,000 investors are having problems, and that's one of the reasons why some of them are selling. And overall financial stress went up in the ACT, in New South Wales, in Queensland, in South Australia, in Western Australia, 47.6%. And that's 4.7 million out of the 10 million households, so 47%. So it's quite a significant issue, but of course not uniformly spread. Another way of looking at it is by segments, and you can see there that young growing families, first-time buyers, have a significant issue for the mortgage sector. In the rental sector, it's the multicultural establishment, the first-generation Australians who are finding it really tough, but others too. Stressed investors, they tend to be aggregated around exclusive professionals and young affluents because they have a much bigger portfolio of investment properties. And overall financial stress is highest among young growing families, first-time buyers, and at 67%, that means that around 500,000 young growing families across the country are in some difficulty at the moment. So that's the way it works. Now, if we then go into some postcode level detail, this is the first time I've shown this data for February. And you can see there that in the stressed mortgage category, it's Liverpool, 2170 at the top of the list, followed by Roxburgh Park in Victoria, 3064, and then going across to Wanneroo in Western Australia, 6065, then Campbelltown, 2560, and Toowoomba, 4350. Now, my suspicion is that Toowoomba stress level will rise because of the recent floods, but we'll see. Then we go to Narre Warren and Pakenham in Victoria and Tarnit in Victoria, of course, all high growth corridors. Then to Camden in New South Wales, Berwick and Harkaway in Victoria again, Riverston in New South Wales, and then Pine Mountain in Queensland, and Ballarat, just sliding off the bottom of the list. Another way of looking at it is the risk of default. And so this is my forward projection based on what I'm seeing over the next year. And you can see there that Cranbourne in Victoria, Roxburgh Park in Victoria, the area around Mandurah in Western Australia, Success in Western Australia, Tarnit in Victoria, and Armidale in Western Australia at the top of the list. Gosford there as well, 2250. Point Cook in Victoria, 3030. Toowoomba in Queensland, Southampton in Western Australia, Wanneroo in Western Australia, Yatala in Queensland, Bundaberg in Queensland, and then Clyde in Victoria are all where the highest counts are. Now, just to be clear, this is risk of default. This doesn't mean they all fall over, but it means there's a high likelihood. And you can see here that in a couple of these postcodes, we've got 5% or 6%. In others, it's quite a lot lower. And interestingly, the WA story is the hangover from the last cycle where prices fell after people had bought in with big mortgages. And so it's been a number of years for this to work through. And this suggests to me that we are going to see quite a lot more pressure ahead. So we'll see how that plays out. And we'll just look at the rental sector. So here we've got Liverpool, 2170, Toowoomba, 4350, then centre of Melbourne, 3000, Southport, 4215, then Westmead, Campbelltown, Derrimont, Zetland, Tarnit, Coomera, Mount Druitt, Bundaberg, Parramatta, and then the Ipswich area just falling off the bottom there. That's the count of rental stress, so highest there in perhaps areas that you might expect. And of course, looking at stressed investors, Bundaberg at top of the list, Surrey Hills in Victoria, DY in New South Wales, Carnegie in Victoria, Southport, Wavell Heights, Benoa, Samson, Liverpool, Yatala, Toowoomba, Hornsby, Paradise Point, and Parramatta, all on the list from stressed investors. And the point about stressed investors is sometimes they are having little choice but to put their property on the market. We're seeing quite a few of those properties listing at the moment. They tend to be lower quality property. And then finally, if we look at financial stress, you can see here, this is the aggregate level story. So this is Bundaberg, Queensland, 4670, right at the top of the list with 25% of households there. But then we've got Surrey Hills in Victoria, 3127 with 61%. And then DY in that area around there in New South Wales, Carnegie in Victoria, Southport in Queensland, Wavell Hills, Heights, I should say, in Queensland, Benoa in Queensland, Samson in Western Australia, Liverpool, Yatala, Toowoomba, Hornsby, Paradise Point, and Parramatta. So those are the areas where I think the most significant pressures are actually there at the moment. Now, what I want to now do is to take the conversation slightly further and give you a little bit of information about what's going on. And to do that, I'm going to use our scenarios as a baseline because it's important to understand how the scenarios are working at the moment. And then from there, I'm going to look at some specific postcodes. And then depending on the interest, we might look at the mapping that I've got up my sleeve as well. So in terms of the scenarios, let me say again, these are not forecasts. This is the fact that households are potentially up against it, but it depends on how things play out. And so they're just ways of showing sensitivities. And I use three, of course. The best case scenario, which is this one, which we've got rates at 4.1%, they fall later in the year. Inflation eases in line with the expectations from the RBA, although of course it's still at 2.7%, not 2.5, which is the midpoint. Wages rise faster, and we don't get a recession and migration remains above average. So that's the best case scenario. The base case is a soft landing. We see rates around 4.1%. Inflation falls, but then comes back a bit higher. Save up as target until 2026. We don't get a recession. Migration falls to average. And then the worst case, the nightmare, is we see that rates go up again. And we got mortgage rates of 6.5% plus stays high in 26. Along with inflation, unemployment rises and wages growth stalls due to recession. And we see rates falling again. Migration drops below average. So you can see here that the main critical levers are interest rates, migration, and wage rises. So those are sort of critical issues. And of course, inflation and what happens to inflation is by far the most critical issue, because the inflation trajectory will determine what the RBA does. Now, I've had said for some time that I think the RBA is using its rather narrow portfolio of tools, the interest rate lever, and it's not necessarily getting the reaction they wanted. So the question was, will they just hang on, or will they try and do other things? We'll see. I guess it depends on what happens after the election. And as somebody said earlier on, there are people hanging around at the moment just waiting to see what is likely to happen. It's interesting that there are a lot of people just waiting to see what's going to happen with the federal election, which is another level of uncertainty, before they make any big decisions on their financial future. I think that's exactly right. Be right is right there. The bottom line is that there's a level of uncertainty that I've not seen for some time, and confidence levels are relatively low, but there are a lot of people trying to scratch their heads saying, so what should we do? And it's hard to make some good decisions at the moment. What I would say is, whatever you do, make sure you do your due diligence. Now, just before I go into the next part of this conversation, this is, of course, the detailed analysis that we can do down at the postcode level. And the point about this is that it gives you the detailed summary. And I always use Wollongong because it's one I know really well, but you can see there that we can look at both the things like the household structures, how many are owning outright, how many are borrowing, how many are renting. We can look at the mix there in percentage terms too. We can look at the mortgage stress data in percentage and numbers. We can look at things like the housing structure. Is it units, houses, other types of property? We can look at the people ratio. So are these singles? Are they families? Somewhere in between. The vacancy rates. And those vacancy rates are based on the census from some time ago. So they're not totally up to date, but the best we've got. We've got the gross investment and net investment yields for investment properties. These are bang up to date. This is the latest information. And quite often you will see that it's the net investment yield, which is the one I talk about, which is the most critical one, because if you're underwater from a cash flow perspective on investment and you don't think property prices are going to rise, then maybe it's time to sell. Then we've got information on the taxable income. You can see here both the ATO and the census data. And then that flows up through to the disposable monthly income data. This is the critical information. I think that this is something which we should be focusing a lot more on in the mainstream media than we do, because it's telling you about what income is actually coming into the household after tax. And the point there is that, of course, the tax take continues to rise. The tax bands are frozen at the moment. And whilst we had a bit of generosity from the government earlier on, it's not continuing really. So that's important. And then the question is, well, what proportion is actually going on the typical mortgage? Here it's 41% at $2,467 a month, and the typical rent at 33% on 1,993. Now, of course, some people would say, well, if it's 30% or above, then that's stressed. I tend to say it's hard to tell, because what you can see is that in some cases you have high percentages of income going on the mortgage and people are not stressed that much. In others, not so. So it's a much more complicated thing than you might actually think. Right, so that's, I think, the preparation for the conversation done. In terms of the next part of the story, what I'm going to do now is I'm going to do a little bit of a deep dive on the postcodes that I got asked for beforehand. And this is when I made the earlier show. And for those of you who saw the earlier show, you will know I suggested that people put up their hand if they wanted particular postcodes. So the first one tonight is 5159. And to do that, I need to put that into the system. And then I need to cut across so that we can see the screen. And then I need to do a little bit of tweaking here to be able to do that, and then cut that to there. And hopefully, yes, it's worked. Oh dear, it's complicated when I'm just trying to do it all on my own. Okay, so this is 5159. It's in the Happy Valley area of South Australia, in the Adelaide city suburbs. And you can see here we've got 13,000 households. 13,000 households. 35% owning outright, 52% are borrowing, and 11% are renting. We have 25% in mortgage stress, so that's relatively low. We have quite a lot in rental stress at 87%. Most of the properties here are still houses, a small number of units, other types of property. People ratio is quite high at 2.46, so that's going to be a lot of families. If it's below 2, 1 point something, then it's more individuals as well. The vacancy rate was relatively low at 4.1%. Gross investment yield is 4.3%. So that's the one that all the agents talk about. The ratio between the rent you can grab and the cost of buying the property today. But of course, there's a big assumption there. Can you get the rent for the full term, etc., etc.? But the true one is the net investment yield. Net investment yield is the costs of the investment property versus the return that you get in real terms from the rents. That includes things like management fees and also the interest rates that you might have to pay on the mortgage that you have, and potentially repairs and maintenance and other things too. This is the key to understanding investment property, net investment yield, and yet it's the one that's hardly ever reported. On the taxable income front, you can see here that the individual ATO taxable, this is the 21-22 tax year, was $65,148. The household census, which looks at the aggregate household income, was 93,000. And I've got the little multi-flag here. That multi-flag shows you that there is more than one income going on to pay the mortgage at the moment. So when I think about the disposable monthly income, I actually take the aggregate amount in, and that then gives us disposal monthly around 6,100, with 30.9% going on the mortgage and 28% going on the rent, 1,769. And then finally, looking at the scenarios, this is based on the 3 scenarios I spoke about. You can see here that in the best case scenario, there is still significant upside potentially for houses in this particular area. Maybe over the next 3 years, cumulatively 17%, 6% over the next 12 months if things go in the best case scenario. In the base case scenario, pretty much flat or maybe slightly down. And the worst case scenario, of course, a more significant fall. And my own census at the moment is that we're going to be somewhere between the best and the base, but we should also be conscious of the fact that the worst case is not necessarily written out of the script at the moment, especially if we get a hung parliament, for example, especially if the US goes into recession, and especially if inflation comes back and therefore interest rates have to go up again. And units tend to follow on pretty close. So that's that particular one. And if I then go to the next request, and if I go back to that, let me just go there, push that button. Okay, can I do Parks 2870 from Isaac? Your small New South Wales town with major distribution hub being built there. Interested to see what you think. Yep. Very good point. And of course, some of those economic externalities can significantly impact the way that the prices move. So it's postcode 2870. So let's go back to there, put that in. So this is Parks in the Central Tablelands. And you can see there that we've got 4,900 households in the postcode. 36% are owning outright, 35% are borrowing, and 28% are renting. You can see that just over 55% are in mortgage stress, 87% are in rental stress. We've got some stressed investors and overall financial stress at 46%. Looking at the mix of property, 89% of houses, a small number of units and other types of property there. The people ratio is just above 2, so that probably suggests some families as well as individuals. The vacancy rate was quite high, but that was from an old census point, and I haven't got any latest data on that. From a gross investment yield perspective, 3.3%. Net investment yield is minus 1.9%. And that's quite a significant drop, of course, and that's because of the cash flow pressures on investors. Average taxable 67,000, the household census is 73, so we've got a pretty consistent story there, which gives us a disposal monthly of around $5,400, and 28% going on the mortgage, 33% going on the rent. Now here's an interesting storyline where you've got the percentage below that magic 30%, but the stress levels are a lot higher than the previous one. And that's why I don't believe that the story of 30% equals mortgage stress simply can work. And that's why I go into more detailed analysis to be able to look at it in detail as to how it all plays out. The bottom line is that even with these levels going on the mortgage, because the overall income is a little lower, the costs of living are very high, of course, that puts a lot of pressure on households. So that's the story to bear in mind there. And as with all of these things, it's always more complicated than you might first think. If we then look at the next one that we had asked for. So this is postcode 6281, Dunsborough in southwest Western Australia. There's been a huge growth in housing prices over the last 3 years. I'm curious, what do you think going forward? From Penelope, thank you very much for that. So 6281. So we'll put that in. Okay. So this is, as we said, in Dunsborough. And there we've got 3,200 households with 67% owning outright, 43% borrowing and 20% renting. We've got 27% in mortgage stress, a lot of rental stress though, some stressed investors, and overall the financial stress is at 40%, so that's somewhat lower than some other areas. Mostly houses, 88%, but some other types of property there. People ratio is quite a lot lower, so that's going to include some individuals and perhaps just 2 people in one house. The vacancy rate was very high back in then. Remember, that was old census data. That could be to do with the fact that it could be second homes, it could be Airbnbs that were empty at the time. So I'm not necessarily going to take that too seriously at 42%. It's just very high. Gross investment, or it could be, of course, partly finished houses that haven't yet been lived in. But that wouldn't normally be picked up in the census data because it doesn't actually include any households, and the census is based on households, not property. Looking at the gross investment yield, 4.2, net investment yield, 0.6. We have an average taxable of 81 and households of 92, so we get a multi-flag again. Disposal monthly around 5,700 with 40.6% going on the typical mortgage at 2,340 and 38.9 or 243 I should say, going on the typical rent. And looking at the scenarios, well, there is, if you take the best case scenario, still significant upside potential, maybe 14% over 3 years for houses and slightly less for units. On the base case, maybe a slight sideways and slight fall over the next 3 years, and the worst case, a more significant fall, and houses would tend to follow on. So that's that one. And then if I go to the next request that we got, this is from Emmanuel. I switch back that to there so you can see it while I load up the next part of the story. Whoops. So this is 4207. This is Yatala. Okay, let me just put that back on screen. So here we have 25,000 households in this particular postcode. We have 22% owning outright, 38% borrowing, 38% renting. We have 29% in mortgage stress and 86% in rental stress. We also have a third in stressed investor land, and more than half of households in this particular postcard have financial stress, in other words, cash flow. Looking at the houses versus units, 83% of houses, 4.4% of units, 12% of other types of property, and that can be all sorts of things living, for example, over retail or other things like that. 2.55 is a people ratio, which is on the high side, so that's probably families as well as individuals. The vacancy rate was 5.3. Gross investment yield is 4.4. Net investment yield is just positive 0.1%. Looking at the taxable income, 59,000 compared with the household census of 77,600. Multi-flag has come up again, and that's giving a disposal monthly of around 5,300, with 37% or 1,986 going on typical mortgage and 32.5% or 1,745 going on a typical rent. From a scenario perspective, in the best case scenario, there is still potential upside here with maybe 13% over 3 years and 4.7% over the next 12 months. Base case would be a bit more of a fall though, maybe 5% over 3 years, and the worst case, a more considerable fall, and units will tend to follow on. Right, let me go on to the next request. We're nearly at the end of the request section. This is from Prize Cow Productions. Lovely name for a, for a handle. 3709. So let me put that in. Okay, 3709, cut back. Now, this one has a very low count flag, so there are very low numbers here. So it's a little bit difficult to decode what's really going on. And bearing in mind that it's a 0.5% sample, it could be that the sample is a little bit distorted. So take what you see here with a little bit of caution. Nevertheless, we do have more owning outright than borrowing or renting. We have a bit of rental stress going on at the moment, but not mortgage stress. We have mostly houses. We have a people ratio that's somewhat low at 1.48. And we have quite a high vacancy rate post the COVID period, of course. Gross investment yield is 2.8 positive, but the net investment yield is negative. Now, that minus 4.1 might be overstated because of the low sample rate, so be cautious on that. But, you know, it tells you something important, I think. Average taxable, 59,000 versus 61,000 in the census, giving a disposal monthly around 4,300. With 29% going on the typical mortgage at $1,259 a month, and the rent 19.7% at $848 going on the typical rent there. So that's that story there. Right. Well, that's given you a bit of a flavour of what is going on. Now let me just go back and just see what is in the chat and see whether we've got any more questions. For example, George has come up with, can I look at 3043 Gladstone Park? Sure can. So let's put that one in. 3043. Cut back across. Whoops. I missed. I'm going to take that on. Thank you very much, Super Chat. Greatly appreciated. Okay. 2043. And here we have in and around Tullamarine. 7413 is the household count. 37% owning outright. 37% of borrowing. 25% of renting. A lot of mortgage stress, a lot of rental stress. Some stressed investors, and you can see how overall financial stress is very high. I'm seeing this in a number of these outer suburban suburbs in Melbourne. It's one of the reasons why the financial picture is not very good. Houses are there at 76%, but we've got other types of property there as well. We've got the people ratio at 2.34, so that's going to be mostly households. The vacancy rate was 6.2% when the census was done. Gross investment yield is 3.4%. Net investment yield is minus 0.3. Again, that's consistent with what I'm seeing in a lot of Melbourne postcodes at the moment, where investors are underwater from a cash flow perspective. Looking at the taxable income, 64 versus 78. So the multi-flag is up, suggesting multiple incomes going to pay the mortgage, giving a disposal monthly around $5,100, with 44% going on the typical mortgage at 1.2280 a month, and 36.4 at $1,869 a month on the typical rent. So that's pretty painful. Now, as a result of the high levels of stress, even in the best case scenario, I'm not seeing much positive news in terms of house prices in this particular area. So even in the best case, it could be down, let's say 8% over 3 years and 2% over the next 12 months. The base case is a more significant fall, maybe 28% over 3 years. And the worst case is a horrible fall. As I suggest, it's going to be somewhere between base and best is most likely, but it's worth bearing in mind that there is significant downside still in the Melbourne market, in these outer suburban areas. And by the way, one of the reasons why we're seeing quite a few investors getting out, because if you're having a net investment yield that's negative and you've got a prospect of house prices continuing to fall, then your investment's going to go pear-shaped quite quickly. Units following on. And I think that's what we can do on that one. So I hope that was of use. Let's go to this one. Be Right Agent asked, can I do 2602? Sure can. This is Ainsley in the area of Canberra. There we go. Let's get you away so you can see everything. Okay. 14,000 households here, 27% owning outright, 35% borrowing, 37% renting, 1/3 in mortgage stress, a high proportion of rental stress, some stressed investors, and 53% overall in financial stress. We have 55% of houses, 21% of units, and other types of property, 23%. People ratio is 2.2, so that's probably going to be some couples, some families there too. The vacancy rate was 7.4% when the census was done. Gross investment yield 4.7%, so sounds good, but net investment yield is just positive, 0.2%. Looking at the taxable average, 91,000 for the ATO, 121,000 from the census, giving a multi-flag again, with a disposable monthly income around $8,600 a month, giving 30% going on the typical mortgage at $2,625.2%, going on the typical rent, $2,172. And I'd make the point here that this is another example where, with slightly higher income, the overall proportion going on the mortgage may be a little lower, but you can see here that the rental stress pressures on households, not least because of the high cost of living, of course, particularly in Canberra, is a problem. Looking at the scenarios, the best case scenario is a further rise, a small rise in houses, maybe 6% over 3 years, 1.8% over 12 months. The base case is a fall, 13% over 3 years, and the worst case, a more significant fall. Units begin to follow on. Okay, I've got another request here from Prene. 3149, please. Yep, easy. Just take you off screen so you can see the total thing. This is Mount Waverley. 3149. In the Melbourne area, of course, 13,000 households, 42% owning outright, 33% borrowing, 24% are renting. You can see there that half are in mortgage stress, 80% are in rental stress, some stressed investors, overall financial stress at 43%, 68% of houses, 21% of units, and a small proportion other types of property. You can see there that the people ratio is 2.53%, and you can see that the vacancy rate was 7.7%. Gross investment yield is 3.5%, net investment yield is minus 0.6%. The taxable income from the ATO was 79,000 and from the census 107,000. Multi-flag comes up again, so more than one income paying the mortgage. Disposable monthly, on average, about $6,900, with 44.7% going on the typical mortgage at $3,120 and 34%, $2,372 going on the typical rent. And you can see there's a very high proportions. And that's quite interesting, because what that suggests is that whilst the incomes are a little higher here, the proportion going on the mortgage is also higher as well. One of the reasons why we may well be seeing this net investment yield negative, quite strongly negative, because, of course, if you're an investor, you can only put the rents up so far before you hit the ceiling. Okay, what else? Here's one from Not Environmental. Can I look at 2450? Yes, I can. This is, of course, before the rains, so it might be changing now, but this is Coffs Harbour. Thank you for that request. So this is 19,000 households in Coffs Harbour on the north coast. 37% earning outright, 31% borrowing, 31% renting, 21% in mortgage stress, 72% in rental stress, some stressed investors, overall 34.5% in financial stress, which is more than 6,500 out of that 19,000. You can see there that 71% are houses, but there are some units and other types of property there too. People ratios 2.25, so probably some couples, as well as perhaps some families. Vacancy rate was 8.3%. That could be some Airbnb, holiday accommodation, second homes as well. Gross investment yields 3.4%. Net investment yield is minus 0.7%. And that gives us a taxable income average of 62,000 and a census of 72,000. Again, the multi-flag comes up, giving a disposal monthly of just over $5,000, with 41% going on the typical mortgage at $2,080 a month, and 36.6% at $1,843 going on the typical rent. And looking at the household price scenario, I should say, we're looking at some further rises, maybe 15% over 3 years in the best case scenario, but the base case would be a fall, a small fall, 4% over 3 years, and the worst case, a more significant fall, units following on, and of course that was before the latest issues. So we'll see how that plays out. Okay. You're very welcome for that one there, and always glad to help, and be right, glad to help there as well. Pranny asked for, can I do 31502? Sure can. Let's put that one in. Okay, so this is Wheelers Hill in Melbourne, in the suburb of Glen Waverley as well, there as well as Wheelers Hill. 23,000 households, 45% earning outright, 31% borrowing, 23% renting. You can see there that 18% are in mortgage stress, 78% are in rental stress. We do have some stressed investors as well, and 31% over in financial stress, just over 7,000 households. We have 81% of houses, some units and other types of property. We have a people ratio of 2.54. Vacancy rate's quite high at 8.7%. Gross investment yield was 3.5%. Net investment yield again is minus 0.9%. And again, I must highlight, this is another example where the Melbourne story on investment yields is pretty bad. Last month, I did just show you quite a lot of mapping on that. So check out my previous live show if you want to look at the mapping aspect of net investment yield. I'm not going to do that today. Taxable income, 75,000. Household census, 97,000. And that gives a disposal monthly income around 6,300 at 47%. Going on the mortgage at $3,000 and 37.4% at 2,394 going on the typical rent. On the scenario perspective, the best case scenario, small rise, maybe over 3 years, if you're lucky, 1.4% over 12 months and 3.7% over the next 3 years. The base case, a fall of about 15% over 3 years, and the worst case, a more significant fall and units following on. Down under Drover, I should say, ask for 3075. Sure can. This is Lalor. Again in Melbourne. A lot of interest in Melbourne tonight. Of course, maybe no surprise given what's happened with prices over recent times there. So 8,500 households, 40% earning outright, 32% are borrowing, 27% are renting. 85% in mortgage stress, 76% in rental stress, stressed investors at 16% and 51.6% in financial stress overall. You can see there that we have 88% in houses, 6.2% in units, and 4.9% in other types of property. People ratio is 2.64. The vacancy rate's 5.5. Gross investment yield is 3.1. But again, net investment yield minus 0.7%. The taxable income is relatively low at 56,000 compared with the household census of 70,000. Again, the multi-flag comes up, and that gives a disposal monthly of just over $5,000 with 41.9% going on the typical mortgage, 2130, and 34.4% going on the typical rent, 1,749. And looking at the scenarios, even in the best case scenario, I can't see how prices can go up from that point at the moment based on the scenarios. The base case, a more significant fall of 22%, and the worst case, a more significant fall. And even in the best case scenario, over 3 years, maybe 3% or so down. Okay, Jason asks for, can I do 4870? I'll do that one first and come back to the other one. Good old Cairns up in far north. So here we have up in far north Queensland in the SA3 of Cairns South. And we have 29,000 households with 25% owning outright, 33% borrowing, 41% are renting. We have 32% in mortgage stress, 32% in rental stress, 12% in investor land, stress investor land, and 27% overall in financial stress. So financial stress a little lower than some other areas. We have 59% of houses, 25% units, some of the types of property there too. We have a lower people ratio of just over 2. We have vacancy rates. That probably includes some Airbnbs and second homes and those sorts of things. Gross investment yield is 4.1. Net investment yield is just positive 0.1%, so not huge. Average taxable 67,000 compared with 78,000 for the census data, giving a multi-flag and a disposal monthly around $5,600 with 34% going on the typical mortgage, 1,920 a month, and 27.6% or 1,540 going on the typical rent. And looking at the scenarios, well, at the moment, the best case scenario will be continued price rises, so maybe 7% over the next 12 months in the best case and 22% over the next 3 years if things go really well. The base case would be a much smaller rise, maybe 3% over 3 years, units following on. And of course, if things go pear-shaped, then we would expect more significant falls. And then Jason, you also asked for 3070, which we can do. This is Northcote. And here we have 11,000 households with 30% owning outright, 31% borrowing, 37% are renting, mortgage stress at 32, rental stress at 79, some stressed investors, overall financial stress at 44%. We have 49% of houses, 22% of units, and 28% other types of property. Just over 2 for the people ratio and 9.2 for the vacancy rate, 3.4% for the gross investment yield, minus 0.7 for the net investment yield. So once again, I'm afraid Melbourne wins the prize in terms of negativity in terms of investment yields. Average taxable 101, census at 118,000, multi-flag is on. Disposal monthly is about 7,890 a month. 36.5 going on the typical mortgage at $2,880 a month, and 30% at $2,367 a month on the typical rent. And then looking at the scenarios, the best case scenario, well, you might get a small rise, 2.9 to 3% over 3 years if you're lucky. Best case, base case a fall, quite a significant fall, 5 years over the next year, and then 16% cumulative 3 years. Worst case, even more significant fall than units following along. Okay, Wednesday Brown asked for 3041. Melbourne is definitely getting a feature tonight. I wonder why. This is Strathmore Heights, and there we have 5,200 households with 38% owning outright, 37% are borrowing, and we have 24% are renting. We have 80% in mortgage stress. I think that's one of the highest I've seen. 83% in rental stress. Stressed investors at 32%. So the financial stress metric is 75%. That's one of the highest that we've looked at, I think. 64% of houses, 16% of units, and 18% of the types of property. 2.39 is the people ratio. The vacancy rate's 8.5. Gross investment yield is 3.5. Net investment yield is minus 0.5. Average taxable, 91,000. Census said 113,000. The multi-flag is up, giving a disposal monthly of around $7,600 a month with 37.5% going on a typical mortgage at $2,860 a month, and 25.5% or $1,948 going on the typical rental payment. From a scenario perspective, no really good news here. Even in the best case, a small fall over the next 3 years, maybe 8% over 3 years. Base case, a more significant fall, 27%, and the worst case, falls off a cliff, and units pretty much following on. Okay, Matthew asks for 3073. We are going through the Melbourne suburbs tonight. Not a problem. Okay, 3073. This is Reservoir in Victoria. Actually, it's interesting. I've done a couple of one-on-ones quite recently on Reservoir, people trying to work out what to do there. So I know this quite well now. 21,000 households, 32% earning outright, 31% of borrowing, 36% of renting, 78% in mortgage stress, 73% in rental stress, some stressed investors, and overall 55.4% in financial stress. So it's at the higher end. We have 63% of houses, some units and other types of property there too. People ratios 2.17, a bit lower than some others. 8.8% vacancy rate. The gross investment yield is 3.3, but the net investment yield is minus 1.2%. So again, people are losing money on a cash flow basis. Average taxable around 66,000. The household census at 80,000. The multi-flag comes up, giving a disposal monthly around $5,800 a month, with 40% going on a typical mortgage, $2,383 a month, and 30.4% going on the typical rent at $1,794. And on a scenario basis, no really good news. On the best case, a small fall of 2.5% over 3 years. The base case, a fall over 3 years of 21%, and again, falling off a cliff if the worst case scenario hits, and units following on. Could I please review 5214? Sure can. So this is Goolwa North, Currency Creek, and Goolwa. And we'll get rid of that so you can see it. Okay, 4,600 households, 53% earning outright, 25% borrowing, 21% of renting. Overall, 16.7% in mortgage stress, 80% in rental stress, some stressed investors, 26% in financial stress overall. 89% of houses, small number of units and other types of property there. The people ratio is quite a lot lower, so it could well be some singles as well as potentially couples. 1/3 vacancy. Now, could this be students? Possibly, I don't know. Or it could be perhaps some Airbnb. I'm not sure. I don't know the area well enough to be able to figure that out. So it does say Kangaroo Island is the SA3, so well, that could be part of it. Maybe it's holidays, I'm not sure. 4.3% gross investment yield. Net investment yield is minus 0.4. Average taxable 51. Census at 48. Giving a disposal monthly of just over $3,400, with 42% going on the typical mortgage at $1,438 a month, and 40.4%, $1,380. On a scenario basis, houses, still quite strong growth, maybe 18% over 3 years, 6% over the next 12 months. On the base case, pretty much flat. On the worst case, a potential fall. Units following on somewhat close. Okay. Ben says 2745. Yeah, put that one in. This is Luddenham in Sydney. Includes all of these other suburbs too. 10,600 households, 25% earning outright, 53% of borrowing. This is mortgage heartland by the look of it. 53% borrowing, 21% of renting. We have just over half in mortgage stress, just over half in rental stress, some stressed investors, not a lot. Overall financial stress at 39%. We have 91% houses, small number of other units and types of property there too. People ratio is very high, over 3, so probably a lot of families. Vacancy rate is just 3.1%, quite low. Gross investment yield is 3.2, but the net investment yield is minus 0.7. You're worse than Melbourne. Average taxable, 82,000. Household census, 129,000. Multi-flag comes on, giving a disposal monthly of just under $8,000 with 36.6 or $2,915 a month going on the mortgage, and 30%, $2,392 going on the typical rent. On a scenario basis, still upside, 4% over the next 12 months potentially, and 15.5% over 3 years on the best case scenario. The base case, though, a bit of a fall, 3.9% over 3 years. The worst case, a more significant fall, and units following on. Okay, we have, I'm getting very confused when people put 2020 in. I think, is it a postcode or is it a date? Okay. We're looking at Rooty Hill now. Rooty Hill in Sydney, 5,226 households with 24.3% owning outright, 42% borrowing, 32.9% are renting, 57% in mortgage stress, 87% in rental stress. Some stressed investors too, with 56.6%. Also showing up there, it's quite high. 77.4% houses, 3.2% units, other types of property at 19%. People ratio above 3, so again, lots of families. Vacancy rates at 5. Gross investment yield is 3.5. Net investment yield is minus 1.6. So again, another example of a suburb underwater. Average taxable, 61,000. Household census, 103,000, giving a multi-flag there and around a disposal monthly of around 7,600 with 34.2% going on the mortgage at $2,600 a month and 27.5% of $2,093 going on the typical rent. On a scenario basis, best case would be 7.3% over the next 3 years at 2.1% over the next 12 months. Base case, a fall for houses down 12% over 3 years. Worst case, down 32% over 3 years, and units following on. Okay. So Matthew asked, is the base data the census in 2021? Well, some of it is. So the way it works is that I take my base census data, and then what I've done is to update that census data on population growth and migration and those other things. So some of the data is not directly from the census. Others is, so for example, the vacancy rate number. There isn't an easy way of getting an updated vacancy rate, so I use the one in the census. But when I look at the population base, that has moved up because, of course, across the country, people have moved. The taxable income data is from the ATO, the latest that they've made available, the year 21 to 22. And then, of course, the other data comes directly from my survey. So there is a base of 2021, but we've added other information too as well. Now, Linda asked this interesting question. So many in rental mortgage stress and then lots own their own home. The gap has grown and grown, not good for rich people. Yeah, the point is, and I made a show the other day about this widening gap of those that have and those that haven't. So if you're in the situation where you don't have to pay a mortgage or a rent, and maybe you've got some savings in the bank, or maybe you've got investments, then you're not doing too badly. And there are others, of course, with big mortgages that have big incomes and their incomes have grown dramatically. So there are some doing quite well, but there are a lot of people who are really not keeping up. And whilst there's been some small return to positive growth in terms of absolute income growth recently, as I said in my earlier comments above and in my earlier show, over the last 10 years, households have gone backwards. And that's the problem. And what we're seeing is the income not keeping up. The interest rates are very high. So if you've got a mortgage, you're paying a lot more than you were. Inflation is still very high and very sticky. And the CPI inflation rate doesn't tell you the full story by any means. Most people are actually considerably more underwater because of it. And then, of course, if you're living in those outer suburban areas, the other thing that people don't necessarily factor in is the costs of traveling around. So, for example, because of the lack of local infrastructure, you've probably got 2 cars. You've probably got to use toll roads to get into the city, for example, in Sydney or maybe Melbourne. And so all of these things add up. And so the outer suburban areas is where we're seeing a lot of pressure. And then, of course, in the rental story, we have a lot of people looking to live closer in because of the fact that it's cheaper, but then they have to pay quite a lot more. But I'd also make the point that rental growth is restricted it's not directly correlated to home prices, which is one of the reasons why net investment yield is relatively negative. It is correlated to income growth. And so income growth is relatively compressed, and that's putting more pressure. So you've got this bifurcation between those who are actually doing quite well, some, the haves, and others that are not. And unfortunately, what I'm seeing quite often is that it's those who are actually doing quite well, who are very much aligned to the politics and parties, and a feeling that the government's done quite well for them. Unfortunately, there's a big proportion of the base which I think is doing quite badly, but they've given up pretty much on the political system because they're saying both sides of politics have messed around with us. And of course, these circumstances that we find ourselves in have been created by 30 years of bad policy. Poor migration, shouldn't have had as many people coming to the country. Poor lending practice. Banks have been able to lend much more and therefore stoke prices to lend more, to stoke prices to lend more. And of course, the deregulation of the financial system more broadly. We've got the investment community. Now, I think investment properties are important because, of course, the government stepped away from providing rental properties some years ago. And so it is the investment community that provides the rental sector. But of course, they've got much bigger pressures now because of the high interest rates. And they've also got the tax breaks. So that's another factor. So you can go down the list. You can then talk about the lack of supply. And I do believe the lack of supply is part of the story too, which is creating this horrible situation where it's more and more difficult for people to get into the market. And, there was an article the other day saying, well, maybe you should move out of renting and getting into buy a property. But of course, the point about that is if you go and buy a property, particularly if you buy an apartment, as they were suggesting, well, you've still got the things like the strata fees to cover off, as well as the higher cost of energy and other things too. So there's a whole bunch of things that are working against. And so I believe that the debate for this coming election should be around a true reform of housing, not just the incremental, well, we'll build a few more houses, 1.2 million target, and then not really build them, but buy existing property and claim we've added to the stock, which is what they did, which is pretty shameful. So yeah, unfortunately, it is very, very significant. Interestingly, from not environmental, very little damage from the cyclone in Coffs Harbour. That's good news. I don't think it came down as far as people perhaps expected. Of course, it slowed on the way through. I was talking to someone the other day who actually moved up from Victoria and went up to Brisbane. Was right on the coast, absolute beachfront, and his beach has been taken away, and his little creek behind his property is now a raging torrent. So he's feeling a little bit under the weather when it comes to what's been going on. But it does show it not necessarily hitting everywhere. You're right. Also, I made that point as well about the fact that the was outsourced to the private sector and the financial system, and of course the BlackRocks of this world and the AU super funds and the build to rent is all part of that continued process. It's not going to help. Unfortunately, what's going to happen is it's going to add more pressure on the rental sector, and I think that's just going to make it more difficult for people to be able to manage their way through the situation. Jason says, God loves property investors. They can apply land tax to investors plus capital gains, which doesn't apply to primary residences. Yeah, that's exactly right. There is the money spin here going on. And of course, you've got the stamp duty money spin as well. And that's another factor that we should bear in mind. Some of the states are very reliant on the stamp duty. And whilst they've sort of moderated in some areas and other areas not. This is a disaster that has been running not just for a few weeks or a few months, but a disaster that's been running for a number of years. I may have said this before, but I'll say it again. I made my first show for the ABC in 2001 when I published my first surveys. And I talked about the risks to the housing story in Australia, because at that stage I was seeing the early signs of deregulation, the early signs of house prices beginning to accelerate, and the affordability pressures building, and the rise of the investment community, the rise of mortgage brokers, the deregulation of the financial system, all of those things. And I basically said that unless you change trajectory, in the future, it'll be more and more difficult for people to get into the market. They'll have to put a larger proportion of their income in to be able to get into the market. They'll be buying smaller properties. They'll be buying less well-built properties. And it's going to be effectively the end of the Australian dream. And I'm afraid that's where we are. For many people, the Australian dream of owning a block of land with a house on it has pretty much gone. A lot of the new developments, of course, are on much smaller lots. So you may have a big room space, but almost no garden space. I think it's very crowded in, very noisy, of course, in those environments. And of course, we've got high-rise, and the high-rise story is even worse with the very poor quality of construction and the fact that a lot of the strata fees are rising very quickly because they've got now much bigger maintenance bills than previously. All of that's part of the mix. So the question is either side of politics likely to want to do anything about this in real terms? And I have to say, I don't think they will. Because if they did, they would probably want to see property prices fall. And, you may remember the old story from the week where the housing minister said, no, I don't want property prices to fall. I still want them to go up sustainably. Well, we are in unsustainable territory. And the question, of course, is how much higher can house prices go? Because if we continue to play the script as it currently is written, we will see more lending. We will see longer mortgages. We will see people more geared up. They will buy a property later. They'll hold it into retirement. And everything, of course, is then designed so that effectively, who wins? Well, the government wins in a way. High tax rates, high stamp duty rates, high land tax, all of those things are part of the story. And what I find frustrating is that no one in the political sphere really wants to accept what a mess it is. They're all saying, yeah, we've got an issue, but we can solve it. Well, if that's true, then you need to be doing things, politically speaking, very differently from the ones you are doing, which is to promise to build 1.2 million homes and then not get anywhere close, to promise to build new properties using the Housing Future Fund and then not, but using existing homes, which of course means they were taken off the market from somebody else. You could make this stuff up. But then I don't think either side of politics is very clear about this. And I'd also make the point that migration is still very strong. So it's come back slightly, but it's still very, very strong. And migration is definitely one of those things that is driving this as well. And as I said with Edwin yesterday, I'm seeing quite a lot of evidence of people coming into Sydney where, in fact, they've got a lot of money coming from overseas. And with the exchange rate where it is at the moment, very low at the moment, thanks to the broad issues we touched on the top of the show, maybe not surprising that we are seeing the story continuing to play out in a way that is not good for Australian way of life. And in fact, Tarek Brooker made a very interesting post on his Substack talking about Australians eating their young. And that's what's happening. It's getting more and more difficult for young people to get into the property market, to actually have anything like a lifestyle that makes any sense. And that should be what the election is about. Won't be, but should be. Linda makes the point that prices have dropped. Yeah, house prices have dropped in some areas of Sydney, although, of course, the big news from CoreLogic was that had reversed. Well, I'm not sure. We'll see. I'm of the view that we are still seeing quite significant falls in some areas. We're also seeing poor quality properties coming on the market. And that's another reason why prices may be varying a little bit. And Down Over to Over says, well, you need to fund welfare and pork barrelling, don't you? Yes, there is a lot of pork barrelling going on. There's a lot of money going into places that you really wouldn't want. And, well, it's an interesting question, isn't it, about voting? As Jake says, young Australians should stop voting in the next election. Well, you could probably get fined if you do not vote. The question is, what are the options that people have that you could vote for that would actually make a difference? And that's really that'll be the battle for mind share over the upcoming election. There's some interesting stories around, potentially, maybe some alternative stories that we could perhaps think about. But it is not straightforward. It's not easy. And at the end of the day, the two parties have effectively the Australian community by the throat. And through the changes they've made to the electoral system and the way that the voting system works generally, it's hard to see how this can break out. But, the bottom line is people, I think, need to understand just that things are not great. And what I find very frustrating with all of this is that, I get accused of being a property bear. I'm not a property bear. I believe that property is useful. I've made significant money over time in property, and that's fine. But the point is, you've got to look at it holistically in the context of the overall community and society. That's really something to think about. Not environmental. Is there time for 2264? Well, guess what? Yes, there is just. We're getting close to the end of the show, but I will just be able to do one more for you. So 2262, not least because I really enjoy looking at these places. I've learned a lot about Australia from looking at these. So 2262. Just coming through there. There. Get rid of that. Okay. Now, this is in the Central Coast, of course. 8,300 households, 34% earning outright, 37% are borrowing, 27% are renting. We have 56% in mortgage stress, 80% in rental stress, some stressed investors, and the financial stress is at 50.9%. We have 91% houses, small number of units and other types of property. We have a people ratio of 2.33. The vacancy rate when the census was done was 7.4%, probably some Airbnb possibly there as well. 3.4% gross investment, net investment yield minus 0.7. Average taxable, 56,000. The household census, 70,000 per annum. Multi-flag coming up saying more than one income, giving a disposable monthly of just under $5,000 with 43.3% going on a typical mortgage and 39.9% or $1,918 going on a typical rent. I'm seeing this in a lot of those Central Coast areas, a lot of stress up in that Central Coast. And looking at the scenarios, best case scenario, a rise of 9% over 3 years and 2.9% over the next 12 months. On the base case scenario, a fall, maybe 9% over 3 years. And the worst case, a more significant fall, about 31%. Units following on. Boss man, you just snuck in. This will be the last postcode. 4510. Always keen to help. Caboolture. Okay. Last postcode for tonight, Caboolture. 21,300 households there, 26% earning outright, 35% borrowing, 37% of renting. We have 16% in mortgage stress, 87% in rental stress, 26% in investor stress, and overall financial stress at 42%. 83% of houses, some units as well. We have the people ratio at 2.43%, and we have the vacancy rate at 6.9%. Possibly that could be some Airbnb, second home, etc. Gross investment yield 4.4%. Net investment yield just positive 0.1%. Taxable income 55,000 compared with 68,000 from the census. Multi-flag is on, giving disposable monthly around $4,800 a month with 39.5% or $1,906 going on average on a monthly mortgage repayment, and 33.5% or $1,619 a month going on the typical rent. And then looking at the scenarios, best case scenario, well, 16% over 3 years, best case 5.7% over 12 months. Fall of 2.9% over 3 years, base case, and 23% worst case, and units following on. And so there we are. And Jason, just appreciate your super chat. Thank you so much for all your support. It really makes a huge difference to what we do here and for the show. So once again, really appreciate it. Thank you. Okay, so just as I now want to bring the show to a close, let me just make a couple of changes to the story here. Okay, I want to go there. I want to go there. Okay, so we've been talking quite a lot about the pressure on households, and I just want to give people a couple of suggestions as to what to do and where to go for help. If you do have a debt problem, don't just Google and try and find somebody to help. Go to the Debt Council, the National Debt Helpline on 1-800-007-007. This is the one that's government backed, and it is very useful to speak with them. They're very busy. They've got huge numbers of people, but talk with them. When you do talk with them, it's worth taking a cash flow along. And in fact, here's a tool. The AFCA Statement on Financial Position is a tool that you can download from their site. If you just Google Statement of Financial Position, AFCA, you can go find it. And you can open the statement and put in things like what you earn, what you owe, what your living expenses are, what you own. That's a really useful form to be able to put in a quick statement what's going on. One of the things I find quite often is that people are not very clear about what their financial position actually is. They've got a rough feel, but no more. This tool allows you to be much more specific, and that can help whether you're talking to your bank. If you've got a mortgage, of course, the banks are obliged to help, although sometimes the help they supplied is more to do with helping them rather than you restructure the mortgage, extend the mortgage term, etc. Not always best. So sometimes it is better to get independent advice from the debt counselling service, for example. But this statement form is quite helpful there. So that's a couple of suggestions in terms of if you need help. Now, if you're interested in getting hold of the full set of data, it is available. And for those who support us via Patreon, thank you very much indeed. There are different tiers at which you can support us, and they are greatly appreciated, those who do support us that way. But if you want to get hold of the full set of data, more than 2,000 postcodes, analysed down to the level that we went through today, it is available. It's $50 plus GST a month. And the link is there and also in the comments below the show. You can subscribe for as long as you want. You can get it each month, or you can just get it 1 month and then unsubscribe, whatever you like. But that gives you the full access to all the data. And if you're looking specifically, for example, at a particular area, or if you're looking to try and find an area where the net investment yields are stronger, for example, that can be quite useful too. So that is available, and I have quite a few people who subscribe. Those who have subscribed already, just to let you know, I'll be sending out the data on Thursday to the mailing list. And just while I'm talking about other information sources, of course, I do have a blog as well. The blog enables you to be able to follow up on everything I do. I used to send emails from the blog every time I made a post, but I've stopped that at the moment. So you can follow me there and go in and look at all the information. Of course, you can also follow me on Twitter. And if you'd like to make a contribution, one-off contribution, always appreciated via PayPal, and thanks for people who do that. It just helps to keep some of the costs down. I don't do this for profit, but there are costs involved in just running these shows and doing all the work we do. So it all is part of the story. Now, ABS said, can I do 2213? Well, you've twisted my arm. You've twisted my arm just to show you that I can be responsive. This is the last postcode, and then I'm going to sign off and tell you about next week's guests before I go. Okay, so let me put this one back up and put this on the screen. Okay, so this is East Hills in Sydney. And here we have 8,400 households, with a third owning outright, 40% borrowing, and 26% are renting. We have 34% in mortgage stress, 81% in rental stress, some stressed investors, overall financial stress at 41%. We have a 70% in houses, 4.5% in units, and other types of property, 24%. Vacancy ratio, people ratio is 2.73%, the vacancy is at 5%. Gross investment yield is 3.3. Net investment yield is minus 0.7. So another of these negative suburbs, I'm afraid. Taxable income, 74,000 from the ATO on an individual basis, 110,000 from the census, giving a multi-flag and an average disposable monthly income around $7,000. 44.1% going on the mortgage at 3,120 a month, and a third, 33.1% actually, at 2,343 going on the typical rent. Which is high. Looking at the scenarios, best case up 11% over 3 years and 3.7% over 12 months if everything goes wonderfully well. Base case a fall of about 7% over 3 years. Worst case, a more significant fall than units follow on. So there we are. That's pretty much it. Yes, Down Under Drover. Leith is coming back on. Leith has come back on the 15th, I think it is, of April. So he's scheduled to come back on. We've got Tarek will probably pop back in sometime, but he's very busy doing other things, so he doesn't come on as frequently as he used to. But hopefully he'll be back. And as always, of course, the conversations that we have will be determined also by my recorded show. Just to tell you that next week, we've got a new guest coming on. I've changed the order slightly for various reasons. So next week, if I go back to this one, you can see that I'm going to bring you the Associate Professor Andy Shumalo. Now, Andy, of course, actually based down in Wollongong, is very active with regard to financial reform. He gave some very important evidence to the recent inquiries, and is now standing in the Citizens Party for a Senate candidate for New South Wales. So he's coming on to chat about the financial services sector more broadly, financial reform, and perhaps chat a little bit about also his aspirations with regards to his candidature. So that should be interesting. So that's next week. And then the following week, we're going to have Spacious back on. Spacious was coming on next week, but I've moved him back a week just to accommodate my schedule with everything else that's going on. So Spacious will be on in 2 weeks, and we'll be looking specifically at some of the latest data on home price trends and all those things there. So that should be worthwhile. And as Dan Overdrover says, he's good value worth giving Citizens Party a vote. Well, like I said earlier on, if you vote for the two major parties, you're going to get the same old, same old. At least people like the Citizens Party do have a different platform and a different approach to dealing with housing and those sorts of things, as well as some of their other platforms. So if you think it's worthwhile, then listen to Andy next week and make your own decision. What I'm trying to do here is put a information out. I'm not politically aligned to anybody. I don't support the Citizens Party directly, but I do think that some of the points that they make are worthwhile, very important to consider. Right, well, we're pretty much done. We've hit the end stop on the show, so thank you very much for spending some time with us this evening. Really appreciate it. Thank you very much for all the super chats and all the requests. I hope you found it useful. I'll be doing a somewhat similar show in a month's time when I will have updated information, and I'll focus probably in there on some of the other angles in my data. Part of the issue, I've got so much data, I don't know which to look on, but we'll see. So before I go, we shall just look at the dog actually, not dogs. Luna's been there all the time. Meteor is down here by my feet because she thinks it's time for lunch. So she's given me a hurry up, which she often does around this time. So I'll say thank you very much. Go and feed the dogs now. Have a good evening. I hope those in and around the Queensland area are drying off and damage isn't too severe. And you get back on your feet soon. I hope that those with you with financial pressures are able to figure out what to do and take some steps to be able to alleviate some of the pressures. And for those considering getting into the property market now and look at the financial markets more broadly, be cautious and careful. There's so much uncertainty out there, and sometimes just taking time rather than jumping quick makes sense. Anyway, this is Martin North from Digital Finance Analytics signing off. We will see you next time. Take care.